Hey everyone, happy Friday, August 30, 2024, the day before the long weekend. I'm Phil Hodgen, and welcome to the Hodgen Law PC International Tax Lunch. We do this almost every month on the last Friday of the month, noon Pacific time. You can watch it now, which is what you're doing, live and in person, and you'll hear me talk or cough or swear or whatever. Or you can watch the show later on YouTube, which is unedited, so you get the same effect anyway. This is courtesy of Cal CPA, and I just want to put a plug in for Cal CPA. I've worked with them for many years on tax conferences and doing webcasts and in-person stuff. And it's a treat and it's a pleasure to be associated with them. Um, This month topic, this is number 5 in the series of 6 about foreign investment in U.S. real property. And this month we're going to talk about the extremely prosaic and boring. What do you do if you got rental income? You as the accountant, how are you going to advise the client? How are you going to do tax compliance? All that fun stuff. So all the big glory is usually in the structuring and oops, I chose the wrong structure. Oops, I'm exposed to US estate tax, blah, blah, blah. Now we're just going to talk about how do I pay rent? How do I pay tax on the rent that I collect? So let's go. Now let's see if we can make this. There we go. Um, First things first, here we are on the sequence. Next month will be the final one, which is going to be a case study. And it's going to be specifically a case study for sale of real estate. Cal CPA said, hey, why don't you put some California specific stuff in? So we're going to do it. What happens when you've got a personal residence and it's sold? And rather than just do a generic sale of a personal residence, I'm going to give you a template for what we actually do and have done many times for people who have a high-end house in personal use and they want to sell, and FIRPTA withholding is a pain in the neck. How do we drop it into a C corporation, do the sale, liquidate the C corporation, everybody go on their way? So you're going to see from start to finish that kind of scenario. So that's what's next month, September 27, 2024. So here's the whole series of this month's, and you can see that is pretty simple. There are two ways that rental income is taxed, and I'm going to talk about um, cash money rental. I'm not imputed income is off the table for this month. It's either fixed or determinable, annual or periodic, or it's effectively connected income. And those are taxed differently. And I have a definite preference, and you will too, for effectively connected income. So your main job will be steering the boat to get into that harbor. Let's go. Introduction. By the way, I'm not going to be taking questions on this. Rachel will be and is in the chat right now, so she can copy paste and drop them, into Slack for me afterwards. Or you can just email me, and my email address is on the last slide, and we can follow up on this. But, after this is done, we got to get out for the long weekend, don't we? All right. Enough asides, let's start. Okay, as I said, there are two systems of income taxation that are going to apply to cash rent collected, right? Whether you've got an industrial building, a apartment building, whatever. One is the FDAP, as they call it, fixed or determinable annual or periodical income, and that's a 30% of gross, no deductions. Um, the second way is effectively connected income, and that basically puts you in a position that's almost exactly like a resident real estate investor would be taxed. There are always little wrinkles, because it's tax, but for the most part, that's where you're going to be. Depreciation, just like passive activity losses, just like blah, blah, blah. So your primary job, if you are faced with someone who is a non-resident investor in U.S. rental property, will be to engineer things so that you are assured of getting into the second category, effectively connected income, where the rental income is taxed on net income. How much money did you collect in rent minus what are your allowable deductions, including depreciation and all that stuff. And for those of you who do a lot of real estate work, you know that the difference in gross and net is profound because of depreciation deductions, mortgage interest deductions, and the like. So primary purpose is to get on track. And then once you're on track, things are enormously predictable. So let's talk about this FDAP stuff. So fixed or determinable annual or periodic income. Actually, I think the way it says in the code is fixed or determinable annual or periodical income, but we'll see the actual code section in a couple slides from now. And the basic idea here is that the non-resident investor is going to pay 30% of gross rent collected, end of story. And there are four things that happen or need to happen in order for this tax to be true. First things first, you have remember we have I'm going to just assume a non-resident alien human being as the real estate owner. So just to make it simple, but it's exactly the same for foreign corporations. But first things first, income is from a U.S. source because the United States government cannot, as much as it would like, tax a person who is outside of the United States on income earned outside the United States. So income from a U.S. source set first. Second, received by the right kind of taxpayer, a non-resident alien or a foreign corporation, right? A resident person is taxed the way that you know you pay tax on your personal income every year. Section 1, graduated rates on taxable income. Third thing is you have to have the right kind of income that fits within this category of fixed or determinable annual or periodical income. And that's in these two sections, 871A for humans, 881A for foreign corporations. And the final thing is that the taxpayer cannot be engaged in a trade or business in the United States, so that it's impossible for this income to be flagged as effectively connected income. And I'm going to talk a lot about what it means to have effectively connected income. Now, in theory, it is possible for a foreign taxpayer to have a U.S. trade or business and also to have U.S. source income that is not effectively connected with a U.S. trade or business. But in practice, and again, I will refer to this later, there is a code section, 864C3. Anyway, there's a site on a later slide, which is colloquially called the limited force of attraction rule that tends to want to suck income that is not effectively connected to income into being effectively connected income with that existing trade or business. So if you don't have a trade or business, there's no way to have effectively connected income, and therefore it's going to be this FDAP thing, tax at 30% of gross. So here's the rule for corporations. You see, I've got the four elements helpfully bolded. Sources within the United States, type of taxpayer, non-resident alien individual. There, rents in 871A1A called out. And at the bottom, effectively connected with a conduct of a trade or business in the United States. So if you don't have a trade or business in the United States, it can't be effectively connected, because that would be like having a tug of war with only one person holding one end of the rope. Here's the equivalent, and I'm giving you this just to show you that the words are exactly the same for foreign corporations. And from now on out, I'm just going to refer to non-resident alien individuals, but just assume that the same rule is there's a mirror provision in the foreign corporate sections 881, 882. Otherwise, we'd be here and I'd be saying, and then for foreign corporations, same rule over here, which is a waste of time. But you can see again, the same four elements: source, type of taxpayer, type of income, and trade or business does not exist. Or technically, there's no effectively connected with income with a trade or business. First things first, it's but it's worth looking at. 861 is the rule that says when is income from a U.S. source, and Section 861A4 says if the property is in the U.S., then the rent from the property is a U.S. source income. And I've got to say, and I commend it to you for your practice, always go back to the principles, like go back to Section 61. Yes, this is gross income, and follow the trail all the way through. And if you do that one step at a time and you're confident in the linkage from Section 61 to, which is gross income all the way through, you will reason yourself to the right answer. Whereas if you sort of dive in halfway through in some random code section, speaking for myself, I've gotten off track from time to time, let's just say. So, never hurts to go back to basics. Now, by definition, tax on gross income means no deductions. And again, here's a why? Well, 87, this is a typo. Thank you, Peter Elner, for sending me an email about an hour ago. He said, hey, slide 11, there's a typo, 873. Thank you. But see what it says is this 873 says, when are you allowed as a non-resident alien individual to take a deduction? Well, the answer is when it's income that's taxed under Section 871B, which is the effectively connected income section. And remember that this FTAP, fixed or determinable annual or periodical income, is taxed under 871A. Therefore, the code section allowing a non-resident alien to take a deduction simply doesn't apply to the Section 871A income. So if you have a rent that's taxable there, this is why you do not have a deduction. And question about tax returns. Are you going to have a tax return payable, fileable if you have this income taxed under Section 871A? The answer is no. If the tax liability is fully withheld, satisfied by withholding its source. So if you have a 20-unit apartment building, you are a non-resident alien individual, and all of your tenants, including that certified master mechanic at the Lexus dealership down the road, who is your tenant, is withholding 30% on the rent he's paying you and remitting it to the government every year with a 1042, 1042S. Good luck with that. Then you don't have to file a tax return. But if your income is not fully satisfied by withholding its source, then you got to file a tax return and pay the tax. And I joke about the certified master mechanic at the Lexus dealership because, in fact, I know a guy like that. And when I had a Lexus, I was taking my car to him, and I can highly recommend finding indie mechanics like that who fled the big dealerships. So if you have one of these situations and you're going to be paying tax at 30% of gross, just goes, here's the 1040 NR. There's an equivalent one for the foreign corporation on the 1120F. But you put your $10,000 of rent income in, get to the bottom of this 30% tax by default, and calculate the tax, $3,000, and then you can see at the second arrow it says port that number over to the 1040 NR line 23A, and there you go. It drops there. And the reason I gave you this schedule where you report the income, calculate the tax, and then port it over to the tax return is because then it makes it super, super clear that this rental income is not dropping into your gross income, which becomes total income, and then you make adjustments and becomes adjusted gross income, and then you take deductions and it becomes taxable income, and then you compute your tax. No, the tax just blobs straight onto the form 1040 NR after you've done all that computation on taxable income. So bypasses all of that completely. So now what happens if you don't file a tax return? Well, the first thing is, like everything, statute of limitations is open forever and ever, amen. And the 3-year clock is going to start ticking when you file an income tax return. Second bullet point, there's a shortened period of time that you have for filing a late tax return to assert a trade or business status and therefore be allowed to take a tax deduction. And I'm going to talk a lot about that in a few slides from now. But the idea here is that you're taxed at 30% of gross, and let's say you're running this for a while, you say, oops, I shouldn't have done that because that gets expensive. I'd rather pay graduated income tax rates on net. Can I do that? Well, the answer is if you're going to file a late tax return or to put that status on because you never filed before, there's only so many years you can do that. It's not necessarily a bad thing, right? But you're giving up 30% tax rate and you're going to a potentially lower income tax rate on the graduated tax rates in Section 1. So that's good. Second thing is are you getting taxed on gross income or net income? Well, if you lose the ability to take a tax deduction, right, because you waited too long under this reg that I will talk about in a while, at least you're going to be taxed on gross income, but you're going to be taxed at a lower rate. So like if the individual rates turn out to be, I don't know, 21% or whatever they are for the amount of income that you earned rather than 30% under the normal FTAP rates, you're better off. Anyway, the third one is if you're going to do this Form 8288B game and try to get a withholding certificate to reduce the amount of FIRPTA withholding on sale, you need to have 3 years of income tax returns in the bucket with the IRS in order to qualify for that. Well, I think the Form 8288B idea is a bad idea. And I traded emails with Yoav Etzion in Vegas this morning about this, and we came to the same conclusion. It's really slow. On the other hand, it's annoying. So don't do it. But if you do want to do this and you're willing to wait up to 18 months to get your certificate from the FIRPTA unit via Condios, you need to have 3 years of tax returns in the bag. On the final thing on taxed at 30% of gross on the rent I collect. If you have a foreign corporation, so here's the difference between individual taxation and foreign corporation as the owner of the real estate and collecting rent. We'll talk about branch profits tax in a while in the context of effectively connected income, but the branch profits tax does not apply to income that you earn that's taxed under Section 881 for foreign corporations. And here's why. Because the branch profits tax is only imposed on effectively connected earnings and profits, and effectively connected earnings and profits can only exist if you have a U.S. trade or business. And by definition, we're assuming that you don't have a U.S. trade or business, or if you do, this rental income is not associated with that U.S. trade or business. Therefore, the foreign corporation has earnings and profits, all right, because it earned income, but it's not effectively connected earnings and profits. It's just regular earnings and profits. And the branch profits tax is not imposed on, excuse me, earnings and profits generally. Is imposed on effectively connected earnings and profits. So no worries. So bottom line is if you have a foreign corporation and it is being taxed at this 30% of gross, it's just going to pay tax at 30% of gross. That's its income tax as compared to the 21% rate normally. And it avoids the branch profits tax where there's significant benefit of that. And I'll give you the math later in a later slide. So there's the bottom line. I think I've had this a lot of times where people have rental income and either they hallucinated or they truly believed that they didn't have to pay U.S. income tax on the rental income, and we've had to clean it up. And sometimes if you're going back in time, you're going to be filing tax returns and paying 30% of gross income too bad, so sorry. And that's going to be some expensive tax years. That's the context that I've seen it in. Otherwise, because the net election, which we'll talk about in a while, exists, where you can effectively force taxation on net rental income, deducting depreciation, deducting mortgage interest, deducting repairs, blah, blah, blah. I don't see it. I mean, so this is going to be more, oops, I'm cleaning up some messes situation in my experience. So let's move on to the second way, which is by far the most important way, in which, except for the odd cleanup project that you have from time to time, this is where you're going to live. Effectively connected income. So I put on the introduction slide to this section that you tax like a resident and say, what is required for a non-resident to be taxed just like a resident? So you have two twins, right? One twin is a non-resident alien, owns a 20-unit apartment building in Los Angeles. The twin separated at birth is a U.S. citizen, owns the next door 20-unit apartment building in Los Angeles. How are they taxed differently? Well, in order for the non-resident twin separated birth to be taxed the same way as the other one, have to be engaged in a trade or business in the United States. You have to have taxable income, of course, because if there's no taxable income, there's no tax. And that income has to be effectively connected, in air quotes, with the operation of that trade or business. So here's the code section. And again, there's a mirror image for foreign corporations. So a non-resident alien engaged in business is taxed as provided in Section 1. That's the normal income tax graduated tax rates, or Section 55, that's the AMT, on taxable income, which is effectively connected with the conduct of a trade or business in the United States. So that's what we're looking for. And again, here's just the quick summary. Tax rates the same as you and I pay. AMT, if it applies, it applies. And then taxable income is something slightly different. So again, back to basics. For those of us who are resident taxpayers, gross income starts with Section 61, all the different kinds of income in the world. For a non-resident, it's effectively connected income. And so you have gross income, which is the same as everybody's income, Section 61, but you have this adjective or adjective phrase, effectively connected. And effectively connected income is defined, as only attached to this trade or business stuff that's going on. And therefore, it's going to be somewhat less than 100% of the income, because 100% of the income of the non-resident would include foreign income, which is obviously out of bounds. So again, starting at the beginning, Section 61, whereas you and I will go straight from 61 gross income to adjustments to gross income to get AGI, to deductions to get to taxable income. In the case of a non-resident, you're going to start at 61. What's gross income? You're going to pass through the portal of Section 864C, which is what's effectively connected. You're going to get to the adjustments largely don't apply, so you could theoretically wave at them as you go by to AGI, which is going to equal taxable income. Pardon me, you're going to taxable income, you're going to take your deductions, of course, and then you're going to get taxed on that taxable income at the same rates that you and I would. So effectively connected, what does this mean? It's defined in Section 864C, and there are like 8 subparts to it. And I'm going to only talk about the part that attacks rental income specifically. And it says in the C2, it says, if you have an income that looks like it would be taxed at 30% of gross because it's fixed or determinable, annual or periodic, we will tax it as effectively connected income instead if one of these two facts or both are true. Either the income is generated by assets owned by a trade or business in the United States, or the income is generated by activities of the U.S. trade or business in the United States. So asset use test and business activity test, that's the jargon that people use. So this is the idea when people say effectively connected, what the hell does that mean? Well, it means derived from U.S. assets or derived from U.S. activities. That's what we're looking at. And the rental income is, in my mind, always going to be effectively connected income because you have an asset in the United States and people are paying you to use or occupy that real estate, rent. And so the asset use test is going to be effectively connected income because of that. So the only open loop is whether you have a trade or business to attach that income to. So if the income came from a U.S. asset and it doesn't relate to a trade or business, which is an activity kind of question, then it's just going to go straight through and become taxed at 30% of gross. If you can attach it somehow and point to a trade or business, then it's going to be taxed as effectively connected income, which conveniently takes us to the next section. What does this mean to have engaged in a trade or business in the United States? So first, just to reiterate, you get taxed in Section 1 and 55, the normal graduated tax rates on net income tax, on net taxable income, if the income is effectively connected with a trade or business within the United States. So what does this mean? There's a thing in, I think it's in Section 864. Anyway, there's this hand-wavy definition somewhere in the code about U.S. trade or business, but it's just pathetically useless. And so what you have here is a concept that's been developed over the years by the tax court and the federal courts generally that are looking at tax cases. And they've come up with this phrase, are the foreign person's activities in the United States considerable, continuous, and regular? So these are the words that you have to remember. And remember that if you are in a beef with the IRS and you're sitting across the table from a revenue agent, or God forbid, you're standing in front of a tax court judge trying to say, I've got a trade or business in the United States, you are trying to bend that person's opinion to your way of thinking that your activities in the United States are considerable, continuous, and regular. So that's what's going on. That's the phrase that you're going to be aiming for. And the non-resident investor can do the stuff, have the activities himself, herself, or can have agents in the United States empowered to do these things, and those activities the agents do will be attributed to the investor. So you can have a bunch of people running around in the United States doing a bunch of stuff, and you'll see some excerpts from some tax court cases soon that show just that. And that'll be fine. And that's the way people do it always, because if you're living 10 time zones away, you're not flying back and forth every time a repair needs to be done on your apartment building that you have in the United States. So there's the phrase, and so here's a quick example. We're going to talk about it on the spectrum from not engaged in business on one end to engaged in business in the context of real estate on the other. So this phrase, again, just putting it there, considerable, continuous, and regular. Here are two tax court cases where you can get the feel that if all the investor is doing is collecting money, that's it, but doing nothing at all. Triple net lease, you can see that's not engaged in a trade or business. Another one which looks close to triple net lease, not exactly, right? The owner's paying property tax insurance, not engaged in trade or business. So just not very profound amount of work required by the owner, just collecting money, paying a few bills. Here is a longer excerpt from a tax court case, where the judge goes through, well, in my opinion, it's not trade or business. Why? Because the activities were sporadic rather than continuous, irregular rather than regular, minimal rather than considerable, right? So this is sort of how it turns out. And, you know, this is one of these facts and circumstances kind of situation. So if your non-resident alien investor is relying on this, you want to be fairly sure that the facts tell a story that favor you. If the tax are the facts, and how active or inactive, how busy or how much like a passive investor this work looks like. If these are in question, you may not want to leave your fate to, a revenue agent, just say. Now let's look at some that were treated, these in tax court cases, treated as a trade or business. First bullet point, he has two properties, hires some people here on the ground to do the work. They negotiate lease, collect rent, pay the taxes, blah, blah, blah. Held, taxpayers engaged in trade or business. And this is the kind of fact pattern that I normally see. People have maybe one, maybe two, maybe three, not, a small portfolio of properties. And they just outsource everything to someone locally on the ground. This person locally is doing more than just keeping QuickBooks up to date and collecting the rent and banking it, and stuff like that. And there you go. And it's fine. And the point that I wanted to bring on this one was that the amount of work the agents did was held to be considerable, continuous, and regular by the tax court. And the second thing I want to point out here is the attribution, just to reinforce the idea that the investor himself or herself does not have to do the work. It can be delegated to the right kind of agent if the right kind of agent is doing the right kind of stuff. So here's another one, Pinchot commissioner, Management was on such a scale, required regular and continuous activity of the kind commonly needed for the employment of labor, right? Calling the plumber because the plumbing is going to hell again, repair, purchasing bits and pieces and all that sort of stuff. Just the normal kind of landlord activity at a reasonable level. This is a trade or business. So in conclusion about this, I think, my experience is for anything above, you can smell it. I mean, if the only thing that's happening in the United States is basically bookkeeping and banking, I think you got a problem. But if there's more than that, any kind of management stuff, I think you've got a decent argument. And obviously, the bigger the portfolio of properties and the type, right? 20-unit apartment building is going to take a lot more work than a single family home that's rented out. But I think you're going to be fine alleging a U.S. trade or business. Now, I want to point out to you the second bullet point. Did you see the age of these tax court cases? Earliest I cited, I think, was 1940. The latest, the most recent one, 1960. It really, I mean, this is not a big deal in my experience. Ever since we've had this net election, I don't think you have a lot of problem, and if you think that you have a U.S. trade or business, you just file and report accordingly. You've taken your reporting position on that. And if you want to be doubly sure, you make the election that we'll talk about how and when and all of that sort of stuff. But my experience has also been that I've seen many investors, just start to file, all right? So if it's a non-resident alien, there's a Schedule E bolted to the back of the 1040 NR. And away they go and they pay the tax, and 3 years statute of limitations passes and you win. So don't think that the only solution is going to be this net election. You can and should properly assert that you're engaged in trade or business if the facts support it. All right, so now I'm going to heroically assume for the most part, that we have a U.S. trade or business. And now we're going to talk about effectively connected taxable income, because remember that net income tax is on taxable income, which implies that it's not gross income, which implies that you have deductions available to you for some reason or another. So how do we figure all that out? The deductions start. So we have gross rent, we have a trade or business, and we are confident that we can say that the rental income is effectively connected to that U.S. trade or business. Taxable income is calculated as starting with gross effectively connected income minus your allowable deductions. And yes, NOL and passive activity losses, Section 469 apply. So we start here. Remember, FDAP, fixed or determinable annual or periodical income, was taxable at 30% of gross because Section 871A says so. Now we're in Section 872B, which is taxation of non-resident alien individuals on effectively connected income. And the sequence you go through is you start by calculating effectively connected gross income. You have to then look at the deductible expenses. And that second bullet point, really, for clarity, should say allocate and apportion expenses to U.S. source. So anyway, you're going to do the normal allocation and apportionment of expenses to the U.S. source rental income, right? If expense has something directly to do with the property, it's allocable there. If it doesn't, you have to apportion it between all the different types of income that the taxpayer has. But normal stuff. You're going to then subtract the allowable deductions that are allowed by 873, the analog for the foreign corporations, 882C, and that's your taxable income. So not too much different from calculating taxable income for a U.S. resident investor. The effectively connected income is not tagged as income, but gross income, but really that's what they're talking about, is at Section 864C. So it's laying the gloss of effectively connectedness on top of the gross income idea of Section 61. And again, I'm just referring to business asset or business activities. That's the key idea. And this is usually not hard to figure out at all for U.S. real estate investors because, well, for individuals who own the real estate directly, their entire life flows up to an individual tax return. But for everybody else who has half a brain, they're going to put it into some kind of holding structure that segregates the U.S. real estate investment from everything else that they're doing. So we'll usually have this dedicated silo that has nothing but a real estate investor, has nothing but real estate driven income flowing upstream. And here is the interesting / horrifying / not very often problem, which is this idea that I made reference to earlier, the limited force of attraction idea, where you would think that if you have a non-resident alien individual and they have a rental property in the United States, they might have some other kind of income coming here and there from the United States. 864C says that there are other types of income that can be generated even if they're not associated with the U.S. trade or business. In other words, the existence of the trade or business sort of attracts this otherwise unrelated income item and makes it an effectively connected item. And the one that everybody always points to is sale of personal property, where ordinarily a capital gain item on the sale of personal property would not be subject to U.S. income tax for non-resident alien, but it could be because of under this A64C3 thing. So I just give that to you as it's a theoretical thing. In reality, do I ever see it? No. In reality, if I have a taxpayer like this and we are unclear about whether the limited force of attraction rules would convert otherwise non-taxable income into taxable income, and we're in the gray zone. What do you think we do? Anyway, there's 864C3, and by contrast, the net election, the effect of the net election is if it applies, the only thing it does is it tags the rental income from that property as effectively connected income and does nothing else. So a smaller tax base compared to Section 864C3. So whether it's good or bad in your circumstances depends, right? If you had that otherwise unrelated taxable income that's sucked into effectively connected income, so you're going from zero to a tax rate that's greater than zero, bad. On the other hand, if you have an item of income that's taxable at 30% of gross, that might actually be better than the actual tax rate if it's sucked in and treated as effectively connected income. So, but the point of it always is make the net election. Just know that, like everything in tax, there are these weird rules that people like to talk about, but really don't apply in real life, or at least they don't in my experience. And my experience is like everybody else's experience. Therefore, what I experience is universally true, right? Anyway, deductions. You're allowed to take deductions, 873A, yay. And that only applies to income as noted before under Section 871, which is the effectively connected income stuff. Important point. A non-resident alien, also a foreign corporation, can only claim deductions by filing a timely income tax return. So you could be in the weird position of having a non-resident alien who is taxed at the normal marginal tax rates of Section 1 on taxable income that is gross income because the deductions are denied by Section 874. So we'll talk about what timely means right now. Timely you'll see this is built into the regs. If you read the code section says nothing about when are you allowed to claim a tax deduction. So for you and me, if we didn't file tax returns for 5 years and we went oopsie and we backfiled all of those old tax years because the statute is still open, of course, we would report income and we're allowed to take whatever allowable deductions there are. With a non-resident alien or a foreign corporation, that's not true. And there are two different rules, one of which depends on whether this is your first year or you filed last year. And the other rule is, what if you never filed, right? Or you didn't file in the preceding year. So there's a filing gap. So the rule for a non-resident alien individual is you have to file your late tax return within 16 months of the due date in order for it to be a quotes timely close quotes return for the purposes of claiming the tax deductions under Section 874. And the parallel rule for corporations is 18 months from the filing deadline. So remember that. So the 16 months from the due date, and the due date means the due date. What happens if you didn't file a tax return the previous year? Well, it's the same 16-month deadline unless the government gets to you earlier and sends you a notice, in which case it's going to be the date the IRS sends you a letter. And I've given you the citation to this sad situation, Espinosa v. Commissioner, where indeed the 16 months hadn't even elapsed yet, but the IRS sent the poor guy a letter, and the tax court said, too bad, buddy, you lose, you're cut off, you can't claim deductions for that year. So it does happen. Now, in that case, he wasn't an entirely sympathetic taxpayer because apparently the IRS had been trying to work with him for a long time, say, hey, come on, get your butt together, right? Get things moving, get a tax return filed, and he didn't, and he didn't, and he didn't. And then They said, here you go. And then he went and he cried to the tax court, and the tax court said, forget it, go away. So, idea here, timely. And the Espinoza case also had I think it was in there. It said, yeah, this is pretty harsh, but there's a policy behind it, which is to encourage people to report their tax liability and file tax returns if they're supposed to on time. And therefore, we're going to say this is legit. And so these are the rules that stand. And due date, just to emphasize here, is if you want the tax deductions for your deductible expenses. Due date means due date, not the extended due date, because the section 874 in the regs refer to the filing date as stated in section 6072, which says April 15 for humans and June 15 for non-resident aliens and all that sort of stuff. Those are the hardwired dates. Section 6081 is where Congress gave the IRS authority to give extended deadlines, if they want to. And so you have to watch, is it explicitly somewhere in section 874 of the regs that the extended deadline applies? And the answer is no, I see nothing there. Therefore, it's the original filing deadline, end of story. And I give you a citation to the Internal Revenue Manual, and that's a provision for what happens if you say, oops, I'm too late. In this case, for that citation, it's for filing a late 1120F, but asking permission from the government to take tax deductions anyway. When will they do this for you? When will they give you a waiver? When will they not? They don't say anything about the extended deadline. So that's the moral of the story there. If you want deductions, file timely tax returns. You always have time to amend, right? Now, once you got the tax return in the window, you can amend. You got the 3-year window. Achieving effectively connected income by election. So here we come to the net election, which is something that personally, I think if you have any kind of rental income activity by non-resident or a foreign corporation, this is just a mandatory. You do it no matter what, because it's a protective election that protects you, that if, God forbid, the government doesn't agree that the facts and circumstances say that you have a U.S. trade or business, then your fallback position is, yeah, but I have the election on file, therefore I'm going to get the same tax treatment. Ha ha. So, and in reality, I've never seen this challenged by the government. I've had situations where I've had to do cleanups and the person has been filing semi-forever and said, yeah, I made this net election. I remember, 15 years ago on the old tax return. We don't have a copy of the old tax return. They just been filing as if. And, I haven't had any beef from the government. We just say, look, they filed on an old income tax return. We don't have any for, but trust me, the net election was made. And they go, all right, fine. Right. So it works. So this is a protective election. And if you read that giant brick of text at reg section 1.874-1A, so there'll be a lot of reference to that in the next few slides. You'll see that when you read between the lines and understand it, it's a protective election. It says it doesn't say pretty explicitly. It's absolutely explicit. It says you can make this election if you are engaged in a U.S. trade or business. You can make this election if you are not engaged in a U.S. trade or business. But the only effect the election will have is on income that is not already effectively connected income. And it will, in that case, promote that income that is not effectively connected income from rental activities into effectively connected income. It doesn't create a make-believe U.S. trade or business. You're still not engaged in a trade or business. They just sort of hop over that thing and say, yeah, we're going to treat the income as effectively connected income. So this is why I'm saying always do this, just get her done. If the rental activity has been going for several years and they've been filing, calculating tax on rental income on the net basis, just without this, it never hurts to do that protective election now. So going forward, you've got that fallback just in case things go sideways. The requirements are pretty easy, right? It's made by non-resident alien or foreign corporation. Um, Here's the critical one. For non-resident aliens or foreign corporations, you have to have derived income from that real estate in the year that the election is made. Okay? That se that second sentence there is just gibberish. Evidently, my editing, well, not my editing brain, my writing brain went sideways there, and added something on. I don't know what I was thinking there. But the idea is you have to have income derived from that real estate in the current year that you're making it. In future years, it doesn't matter whether you had income from that or not. Once you're in the gate and you've made the election and you had the election effective for that calendar year, future years are covered by the election, whether you have rental income or not. For on this slide, I've got to give a shout out to Peter Elner in Norwalk, Connecticut, because he sent me an email, I don't know, 90 minutes after the slides went out to you guys in the email list. And he said, hey, slide 44 ain't so understandable. So Peter, thank you for that. I'm going to talk about this. This one here, the second bullet point, non-resident aliens, you'll see in the reg 1.874-1A, it says for non-resident aliens who are holding real estate for the purpose of production of income, with code words of Section 212, are entitled to make this election. And Peter's point was, well, yeah, but our friendly friends, when Tax Cuts and Jobs Act fixed that, and it said that individuals are not allowed to claim deductions through 2025. This weird thing between 2025 and engaged or trader business, what we're doing here when we make the net election for a non-resident alien who is holding income, holding real estate for production of income, is we're converting them out of the territory of having to justify their deductions under Section 212, and we're moving them over to the territory of having to justify their deductions under the trade or business, Section 162, and all that BS. So I'm going to give you an example. Real estate, right? You hold raw real estate and you're holding it for production of income, right? It's not a trade or business because just sitting on land is not a trade or business. I mean, at some point when you're subdividing and all that, but just raw land is held for production of income. You're holding it for future capital gain purposes. So the non-resident alien is not going to be able to claim deductions under Section 212 because Section 212 is out of bounds for a non-resident alien, right? But the non-resident alien, if somehow could take that raw land and somehow make it into trade or business kind of expenses, then we can start to write off the carrying costs, because that's the big problem for non-residents who buy raw land. You've got property tax every year, maybe you have some insurance, these carrying costs, and you don't get a deduction. You can't capitalize those into the basis. It's just dead money flying away, and you don't want that. So what you do is, let's say hypothetically somebody bought some land and hypothetically they need to generate some income, and on that raw land, they might sign a short-term lease with their accountant or lawyer for that purpose, for the purpose of storing something on that land for 60 days. And that accountant or lawyer might go rent a semi-truck trailer and have it parked on that land for about a month in order to have a place to store that semi-truck trailer, because it's big and you don't want to put it in your driveway. And then at the end of the 30 days or so, you give it back to U-Haul. Okay, now you have a non-resident who had raw land who generated a few $1,000s of rental income from a third party, paid him money. right? And now I've got rental income. You can make the tax election for that year. Future years, you got property tax. What do? Well, the election's in place. I've got a deductible expense. I can add it to basis over time, right? And I can capitalize the expense, or and off you go, or you do a PAL. But one way or another, those expenses are not lost to you forever. So I'm just giving you as a hypothetical. I'm sure it's never happened, but if it did, that's the way it would work. And if it was 4 acres in Bel Air, there you go. I mean, as a realistic matter, it's a beef with the owners, with the neighbors, right? Why are you parking this trailer here? Or it's also easy to get a shipping container just drop there for a month. I would recommend not dropping a garbage bin, one of those big roll-on roll-offs, because people will throw crap into it, and you don't want that. So the effect of the election is just to have effectively connected income as a backup. It does not create the actual trade or business. And off you go. Now you have your hall pass into effectively connected and net income tax liability. Now, how do you do it? Timing, you can do it for any year that the statute of limitations is open for claiming a refund. So you can see here that there's a discontinuity between making the net election and the ability to take a tax deduction. So you could make a net election for a year where you're time bound, that you're not allowed to take a tax deduction for that year. Maybe you'd want to do it, maybe not. The math will tell you. Like if you had a foreign corporation and you say, I'm going to be taxed on gross income at 30% or 21%, yeah, 21% is good until you look at branch profits tax and you say not so good. But maybe if you're playing this clever game that I described with raw land, you might be interested in going back in time to recapture some of those otherwise lost expenses. So how do you make the election? You attach a statement to the tax return for the year that you're making it. You read the regulation there. It says everything you need there. I've summarized it here. It's not too hard. You have to make an assertion, I'm making an election. And then you have to give a list of all the property that they own in the United States, direct or indirect, right, through a partnership or direct title ownership. You have to say what it is. So it'll be on 123 Easy Street. What is it? 20-unit apartment building. Stuff like that. It's not too hard. If you have a partnership, the partners make the election, not the partnership, just to be clear. And again, just reiterating my comment in the hypothetical about the land, you have to have gross income from the real estate in order to make that election. Okay, branch profits tax. We're coming up to the end. Oh my God. Well, we're close anyway. I sent out an email this morning at 6 a.m. with a lot more on this, but let's talk about briefly. Foreign corporations, if they're direct owner, you've got the corporate income tax and you've got the branch profits tax. And here's the part where branch profits tax hits, is Section 3 of Form 1120F, Part 1. And you start with taxable income before NOL on line 1, and you work your way down to the bottom. Now, the important thing I want you to notice here is, let's say you have taxable income, but you have an NOL, which zeroes out the taxable income for the year. So for current year income tax purposes, you have zero taxable income. You see, you could still have a branch profits tax in that year, even though you're not paying any regular corporate income tax. Not so fun. Anyway, you're going to go through some adjustments. You start with effectively connected earnings and profits, line 2, and you're going to give a schedule for how you calculated that number. Line 4 is this is where you are going to report, did you reinvest your E&P into U.S. assets, or did you take it out of the country? And you're going to make adjustments up and down. Line 5 is what's called the dividend equivalent amount. And this is the government's idea of a proxy for, if this foreign corporation wanted to pay a dividend to its shareholders today, how much E&P does it have available for that? Bang, line, that's dividend equivalent, times it by 30%. Line 6, there's your branch profits tax. So Here's just a simple low budget math, how you can see the combined effect of 21% corporate rate and the 30% branch profits tax rate can yield a combined tax load of 44.7%. And the quick and easy math is just there. And you can see, roughly calculated, I've just made an assumption, no NOL. U.S. net equity, did you buy more U.S. assets or did you pay down U.S. liabilities, is zero. That's unchanged for the year. And there's your 44.7% worst case. This little excerpt is from the newsletter I sent out this morning. So if you're on the list and you're here, you probably got the newsletter this morning. You'll see the greater, where I discussed it in great depth. But the first thing is, how do you make branch profits tax less? Well, if taxable income before NOL is lower, then E&P is going to be lower. And if E&P is going to be lower, then dividend equivalent amount is going to be lower. So that's method one. Method two, I know there's some deep magic with earnings and profits, and I am not equipped intellectually or emotionally to deal with earnings and profits. So if somebody else knows about earnings and profits and clever accounting tricks that can be done there, please tell me. But I'm a noob on E&P kind of stuff. Next one is earnings and profits reinvested into the United States. Because what they're trying to do is trying to say, did E&P somehow escape the United States without getting taxed? So if you have a mortgage with Wells Fargo Bank and you pay down the principal, you've decreased a U.S. liability, you've increased your U.S. net equity, and that's going to be a reduction against E&P for the dividend equivalent amount. Because remember, I mean, if you take some money that the corporation has from E&P and use that money to pay down a liability, there's less money available to pay a dividend, right? So it makes sense. And then the final one is branch profits tax. And this one is, you say, okay, all the math is the math, and I have a dividend equivalent amount greater than zero. Here you're manipulating the tax rate, which is by default 30%, but a lot of treaties have tax rates that go as low as 0%. So you're looking for an applicable tax treaty and a tax rate there. And here's the quick summary of what I just talked about. For method four, it's reg section 1.884-1G like George. That's where they tell you all about using treaties to reduce or eliminate branch profits tax. In there, they have a list of the countries and the treaties that work either for zero or for a number greater than zero, but less than 30%. This is where you find everything that happens. And I've used this specifically with the UK company, to reduce the branch profits tax rate, and works like a champ. So those are the ways that you deal with it if you have a branch profits tax problem. But the bigger question is, why do you have a foreign corporation owning U.S. real estate directly? Anyway, conclusion. Let's wrap it up because we're a little bit past time. Your main job is to get out of 30% of gross taxation and into X% tax rate times net income tax rate. Get out of fixed or determinable annual or periodical tax regime and into the effectively connected income tax regime. Foreign corporations complicate things with the branch profits tax. So don't have foreign corporations collecting rent, and file tax returns on time. That's the main thing I can tell you. With that, we are done. Thank you for being here. Next month, as I said, is going to be a walkthrough of a sort of an anonymized version of a bunch of transactions like this that we've done in the last year or two, which is the sale of a residence where ordinarily you would be exposed to FIRPTA withholding, but instead doing a just-in-time insertion of a domestic corporation, completing the transaction, selling it, all in the context of California. So you'll get to see all the fun about filing crap with the Secretary of State and satisfying the Franchise Tax Board and all that fun stuff. Anyway, there we are. See you next month. Bye.